All right, so I think here's the real question. We're seeing some economic slowdowns here in the U.S. I've talked to some traders. They think that slowdown just goes to the rest of the world and kind of slows down the economies and the markets in other parts of the world. Do you agree with that thesis, or do you see Europe continuing to outperform?
So our view is that the US and Europe could be on a completely different trajectory from the economic perspective, right? US economy has been booming for years, while the European economy was at the borderline recession in a deep, deep slowdown, battling all the energy crisis and slowdown in demand and sentiment due to Ukrainian war. Right. So what we are seeing now is slowdown in the US, which I would argue on relative basis in terms of US investors moving back to Europe, it could only emphasize this move. While in Europe, now economy is still at low levels, so that means fiscal multipliers should work better when you're coming from the low levels. We are getting these seismic policy shifts and huge amount of stimulus that will make its way into the European economy with some delayed effect, right? So we don't expect big numbers this or next year. Perhaps you have full impact of the fiscal multipliers from defenses and this broader infrastructure spend in 28, 29. But there is but we know that that's coming, and there is a silver lining from this delayed effect, because actually there'll be no inflationary pressures from the stimulus in the very short term, which means the ECB still has go ahead and continue cutting as they have been in the near term.
Okay, so you're expecting more cuts from the ECB. What about here in the U.S. as we continue to see some signs of a slowdown here in the U.S.? Maybe not in all the hard data, but when we talk to a lot of companies, you're hearing that from them, and certainly here in the U.S., the consumer is quite a bit stretched. If we see rate cutting, at least one rate cut by the U.S. Fed, what does that mean for the U.S. markets in your mind, and what does that mean about the U.S. markets potentially closing the gap?
So when it comes to the US, the big question is it just a slowdown? Or is it actually a US recession that we don't see and there is more weakness underneath the surface? Of course, if it is a recession, you'll get a stronger reaction function from the Fed, but it's not. It is going to be painful if that was to happen. For now, our view is just a slowdown. Soft data is rolling over, and that means that on the relative basis, the rest of the world starts looking more interesting. And when you look at the equity markets, given the expensiveness of the US equity, so we've been arguing for quite some time, they've been priced for perfection. The slowdown tells you that perfection is no longer present. And on the top of things, we have this unwind of mega cap tech valuations. We call it the DeepSeek effect. It doesn't question the earnings story. AI is going to continue to be an important theme in the market. However, it's questioning the PE story of that theme, right? So that's also another leg of investors perhaps diversifying away from these high valuations to parts of the market like Europe that has potential to grow from subdued levels, which from these levels, it's easier to get these positive deltas, right?
Understood. We say often on this show that investors seem to have found religion when it comes to valuation. Before we let you go, Europe, certainly not a monolith. Is there one part of Europe that you see as the most attractive? I would imagine it's not automakers, especially not today. But is there one part of the market or one of the bourses that you think is more attractive than the other?
So let's look at it from a bit longer term perspective, right? Because we've been always arguing that this month is going to be volatile. Actually, in our allocation, we added some defensive tilts. However, over medium to long term, we are arguing that the seismic policy shifts that are coming through and the stimulus will find its way to longer term growth trajectory from the EPS perspective, therefore potentially re-rating Europe over longer term. That could add 2 PE points. And when you think about sectors that could be more vulnerable in a positive way to the re-rating, there are 3 factors that come to our minds. Number one is you want to be in cyclicality over longer periods of time. Number 2, value has more room to re-rate. And number 3, and that's very important, you go down the cap scale to mid caps. Now, the dust has to settle with tariff risks and so on. But over longer term, we think this is where you want to be, because that's the part that will
Okay.
most benefit from what is happening in the economic front.